Welcome back, everybody, to the deep dive. So today,
Oh, it's great to be here.
yeah, we're talking about something that I think a lot of people struggle with. How do you actually analyze a company when you find yourself in a situation where you're looking at a business in an industry that you just don't know a lot about?
Right.
It can feel like you're reading another language.
Yeah, absolutely. I mean, it's so easy to feel lost when you just don't have the industry knowledge. All the jargon, the key players, and the things that actually drive success are different in every industry.
Yeah, and you came to us with this problem. One of our listeners
Mhm.
reached out and said, hey, I found this company. It seems interesting, but I have no idea about this sector.
Right.
And so we dug into it, and we found something fascinating.
Mhm.
An unlikely resource,
Yeah.
credit rating agency.
Yes.
So, at first you might be like, what?
Right.
What do these guys have to do with this?
Why would we care about them?
But think about what credit rating agencies do all day long.
Right.
They're assessing the risk of companies defaulting on their debt.
Mm-hmm.
So to do that,
Well, they have to become industry experts.
exactly. And they have to know more than just the numbers. They actually need to know how the industry works.
Yeah, so they're not just looking at a balance sheet. They're actually like, what makes this business tick?
Right. They're thinking about the industry dynamics, the competitive landscape, things that are really hard to glean just from the numbers.
And the best
Not
part
bad.
is that they publish a lot of this knowledge
Right.
for free
Yeah.
in these reports called rating methodologies.
Mhm.
You can find them right on their websites.
Yeah, it's really great.
So it's almost like a crash course
Is
taught by the people who need to understand this stuff the best
exactly.
in order to do their job of assessing risk.
Yep.
So to make this a little bit more concrete,
Yep.
we wanted to look at an example that was actually in the source material.
Right. And the source material actually lived at ICRA, which is a credit rating agency in India.
Okay.
And they have these guidelines for the Indian cement industry.
Right.
Now, full disclosure, before I dug into this, I knew about as much about cement as I did about astrophysics.
Okay. Oh, I love it.
Get ready to have your mind blown.
All right.
So ICRA points out that, first of all, it's a cyclical industry.
Mm-hmm.
Just like, the economy has its ups and downs, so does the demand and the pricing for cement.
Right. Which means an investor can't just assume, like, oh, cement's always going to grow at a steady rate. You really have to pay attention to those cycles.
Yeah, you can't just assume, steady growth year after year.
Exactly. And a perfect example of that is like the 2008 housing crisis. Demand for cement went way down because nobody was building houses, prices fell, profits got squeezed.
Right.
But here's another thing that might surprise you about this. The cement industry is actually relatively insulated from global trends.
Oh, that's interesting.
Yeah, I know, right? You would think something like cement would be susceptible to global price fluctuations.
Right, exactly.
But the thing is, cement is heavy.
Right.
It's bulky,
Yeah, it's not exactly...
easy to ship around.
No, it's very expensive to ship it internationally. And so most of the competition is domestic.
Huh. So it's like regional dynamics really matter.
Exactly. A construction boom in, say, the south of India might mean huge profits for a local producer, even if the national market's a little sluggish.
So if you're an investor and you're looking at a cement company and they happen to have a plant
Right?
right next to like a booming construction zone,
Yeah.
that's a good sign.
Yeah, that's a big advantage because they're saving a ton of money on transportation costs.
So location matters, just like in real estate.
Pretty much. And ICRA actually highlighted this. They said, companies that have plants close to their customers and away from, the big production clusters, they can often command higher prices and they're just more profitable because their transportation costs are so much lower. It makes sense, right? It's all about getting your product to the customer
Yeah.
in the most efficient way possible.
As efficiently as possible, yeah. And some companies are actually getting really clever about this.
Oh, really? How so?
So, for example, some of them will set up what are called grinding units near their customers,
Okay.
but they'll keep their clinkerizing units close to the quarries.
Okay, remind me, what is a...
So basically, the clinkerizing unit is the one that's doing the initial processing of the limestone,
Okay.
and then the grinding units are the ones that kind of finalize the cement product.
Okay.
So they're basically saying, all right, let's do the heavy lifting near the quarry where the raw material is,
Right.
and then we'll ship the semi-finished product to grinding units closer to the customers, and that way we're minimizing those transportation costs across the entire supply chain.
That's really smart.
It's pretty brilliant.
It's like they're thinking about every step of the process.
Yeah, and that's the kind of insight that you can get from these rating methodologies.
Yeah, and what are some other things that they highlighted as being critical for profitability?
Well, since cement is essentially a commodity,
Right.
most producers are what's called price takers,
Okay.
meaning they have very limited control over what they can actually charge for their product.
Right. So if you can't raise prices...
You got to get good at controlling your expenses.
Yeah, you better be good at keeping costs down.
Right, exactly. And one of the biggest cost drivers, according to ICRA, is power and fuel.
Oh, right,
The
because,
cement production process uses a lot of energy.
yeah, it's energy intensive.
It is. And so these companies are always looking for ways to be more efficient.
Right.
And they're doing some really cool things. We're talking captive power plants, mini hydroelectric plants, wind farms,
Wow.
even experimenting with alternative fuels,
So they're not just a cement business, they're like an energy company.
becoming mini energy companies.
That's fascinating.
Yeah, and then there's also the issue of different types of cement.
Oh, okay. So does that affect profitability?
It does. Okay. So ICRA points out that, you've got ordinary Portland cement, OPC.
Right.
That's like the premium product,
Okay.
higher price.
More expensive to produce.
Yeah, more expensive to produce.
Yeah.
And then you've got blended cement, which is cheaper to make.
Okay.
And you can produce a higher volume of it, even if the per unit profit is a little bit lower.
So it's like classic trade-off, higher margin, lower volume or
Exactly.
lower margin, higher volume.
And companies have to figure out where they want to play in that spectrum.
Yeah.
And, we haven't even touched on branding yet.
Okay, now that's where it really
That's where things get interesting.
branding and cement.
Branding and cement.
I never would have thought.
I know, right?
Who knew?
Who knew?
Okay, so in a market like India, ICRA saying brand development, it's kind of still in its early stages.
Oh, so it's not really a thing there yet.
Yeah, manufacturers aren't really getting those big price premiums for their brands yet.
Huh. And a lot of the brand loyalty that does exist, it's very regional.
Okay, so like local players have an advantage.
Yeah, they have a bit of a home field advantage there.
So it's almost like as an investor, you're looking for the companies that are kind of laying the groundwork
Right.
for strong brands, even if it's not paying off in a huge way today.
Exactly. You want to see those early signs that they're building something special.
Yeah, because it could pay off down the road.
Exactly.
Okay, so we've learned a lot about, the cement industry in general.
Right?
But how does this actually help me as an investor?
Okay.
Analyze a specific company
Right.
that I might be looking at?
So let's think about this.
Yeah.
How do we apply these insights to any company
Right.
in any industry?
It's like we've got the map of the terrain,
Yeah.
but now how do I actually, navigate to my destination?
Exactly. So first we've got to put on our detective hats,
Okay.
and we've got to dig into the company's financials.
All right, so we're talking financial statements.
Yes.
These can be intimidating.
They can be, but let's start with the basics.
Okay.
Profitability.
Okay.
Are they making money?
That seems like a pretty good place to start.
Yeah. Are they consistently profitable, or do their profits kind of swing wildly with the ups and downs of the industry?
And I'm guessing you want to compare those margins
Yes.
to competitors, right?
Absolute benchmarking is key.
Okay.
Are they outperforming, or are they lagging behind their peers?
Right.
And if so, why is that happening?
Yeah, because that's where you get the insights. It's not just the number.
Right.
It's like, okay,
What's the story?
what's the story behind the number?
Exactly. So, for example, if a company has lower margins than its competitors,
Does that automatically mean?
well, hold on.
Okay.
It could mean a couple things. Maybe they're just inefficient.
Okay.
Maybe they're not managing their costs very well. But it could also mean that they're making strategic investments.
So lower margins aren't always a bad thing.
Exactly. It's all about understanding the context.
So now it's making me think back to the cement industry where ICRA highlighted, controlling operating expenses.
Right.
Is like really important.
Yeah. And that principle applies across industries.
So you'd want to look at like their cost structure.
Exactly. How much are they spending on labor, on input costs, on marketing? How does that compare to their competitors?
And are they doing anything smart to save money?
Like, are they implementing any innovative strategies?
Yeah, like those alternative fuels.
Exactly. Or are they thinking strategically about, their plant locations and their supply chain?
Right, because those things can really add up.
They can. It's all about efficiency.
And it tells you a lot about management, right?
Yes, management is another crucial piece of the puzzle.
Because you could have the best business model in the world,
Right.
but if the people running the show
Yeah, if you've got bad management.
are incompetent, forget about it.
Yeah, it doesn't matter. So we want to see a management team with a proven track record. People who are forward-thinking, adaptable, and aligned with the interests of shareholders.
Okay, but how do you actually assess management quality?
Okay, so
Do we just like Google the CEO?
you can start there.
Okay,
But we need to do a little bit more digging.
okay,
Look at their experience.
okay,
What have they accomplished in the past?
okay.
How have they navigated challenges?
Mm-hmm.
What's their compensation structure like?
Oh, that's interesting.
Are they incentivized to create long-term value for shareholders?
Okay.
Or are they just trying to line their own pocket?
Right, because there's a big difference.
Huge difference.
Yeah.
And pay attention to how they communicate with investors.
Okay, so are they being transparent?
Yeah, are they honest, or are they trying to sweep bad news under the rug?
So like red flags would be things like,
Excessive executive pay,
okay,
lack of transparency, a history of, bad decisions that maybe tanked a previous company.
Yeah, you don't want to see that.
Right, those are warning signs.
Okay, so we've scrutinized the financials, we've vetted the management team.
hmm
What's next?
Well, we know from the cement example that understanding the competitive landscape is crucial.
Right. Who are this company's rivals?
Exactly. How intense is the competition?
And are there any potential disruptors on the horizon?
Yes, it's like a game of chess.
Oh, okay.
You've got to know your opponent,
You've got to know their strengths.
strengths, weaknesses.
Their weaknesses, anticipate their moves.
So we're doing some competitive intelligence gathering,
We are.
reading industry reports, tracking the news,
Mhm.
maybe even peeking at what the competitors are saying in
Yeah.
their financial reports.
Yep, the more you understand those competitive dynamics.
The better decisions you can make.
Exactly.
All right, so we've done all this analysis,
Right.
but at the end of the day,
Yeah.
it all boils down to one question.
What's that?
Is this stock actually worth buying?
Ah, the million-dollar question.
At its current price, yes, and that is what we are going to tackle in the final part of this deep dive valuation.
Okay, so stay tuned, everybody.
Valuation's coming up.
We're going to figure out if that intriguing company
Right,
is a hidden gem or a fool's gold trap.
let's do it.
Okay, so we're back
For the final part.
for the final part of our deep dive.
Yes,
And it's time to talk about valuation.
the moment of truth.
Right. We've analyzed the financials, we scrutinized the management team, we've looked at the competitive landscape, but now we actually have to figure out,
Right.
is this stock a good deal?
Yeah, is it actually worth buying at its current price?
It's like finding, a beautiful house
Right.
in a great location with all the features you want.
Yeah,
But if you overpay for it, you're going to have buyer's remorse.
exactly. You don't want to be stuck with a mortgage you can't afford.
So how do we avoid falling into that trap in the stock market?
Okay, so there are a lot of different methods for valuing a company,
Okay.
but the key is to use a multifaceted approach.
Okay, what does that mean?
So think about it like you're trying to measure the height of a mountain.
Okay.
You wouldn't just take one measurement from one angle,
You'd want to
right? You take multiple measurements,
from different spots?
yeah, from different points, and then you'd kind of triangulate.
So we're triangulated to get a range of potential values.
Exactly.
And see where they converge?
Yeah.
Okay, cool. So what are some of these methods we can use?
So one common method is looking at comparable companies.
Okay.
So basically, we find publicly traded companies in the same industry
Okay.
with similar business models and growth prospects.
So their peers.
Yeah, exactly. And we see how the market is valuing them.
So if a competitor's trading at, say, 20 times earnings,
Okay,
and our target company is only trading at 15,
right.
does that automatically mean it's undervalued?
Not necessarily. Remember,
Okay.
the market always has a reason
Okay.
for valuing companies differently.
So there could be
Yeah.
other factors at play.
Exactly. Maybe our target company has more debt, or maybe they operate in a region that's not as favorable.
Right.
We have to understand the why behind those numbers.
So comparable company analysis gives us one data point.
One data point.
What are some other methods we can use?
Another popular one is discounted cash flow analysis, or DCF.
DCF?
DCF. Yeah, it sounds complicated,
Okay.
but it's actually a pretty intuitive concept.
Okay, explain it to me.
So imagine you could invest in a money tree.
A money tree.
A money tree that yields fruit every year.
I like where this is going.
And that fruit represents the company's cash flow.
Okay.
So DCF helps us calculate how much that tree is worth today based on how much fruit we expect it to produce in the future.
Okay, I'm following you. So we're basically projecting future cash flows,
Exactly.
and then we're discounting them back to today.
Right, because a dollar today is worth more than a dollar tomorrow.
Makes sense.
So we have to account for the time value of money.
Okay, but can an average investor actually do DCF analysis on their own?
It does involve a bit of financial modeling.
Okay.
You're working with spreadsheets and projections.
Right.
If you're not comfortable with that kind of stuff, it might be worth talking to a financial professional.
And maybe like a financial advisor or something like that.
Yeah, exactly.
Okay, cool. And are there any simpler methods that maybe we could use to just get a quick gauge of
Right.
whether a company might be overvalued or undervalued?
Yeah, absolutely. You can look at ratios like price to earnings,
Okay.
price to sales, price to book.
And these are
So these ratios basically help us compare a company's valuation to its peers
okay.
or even to its own historical performance.
So if a company's price to earnings ratio is suddenly way higher than its average
Right.
over the last 5 years or something,
That could be a sign that the market is getting a little bit too excited about its prospects.
again,
But again, context is key.
right.
Maybe there's a good reason for that higher valuation.
Maybe they've got some new product or something.
Exactly. Maybe they're on the verge of a major breakthrough, or maybe investors are just caught up in the hype.
Right. We got to be careful about the hype.
Always be skeptical.
So it's not just about crunching numbers. It's about understanding the story.
The story behind the numbers.
Yeah, that's what makes investing so fascinating.
It is.
It's not just like
It's not a simple formula
black
thing.
and white. It's
Yeah.
like there's this whole narrative.
Exactly. And you have to be able to piece it all together.
This has been so insightful.
I'm glad you think so.
Yeah, we've gone from feeling completely lost in an unfamiliar industry
Right.
to having this framework for actually analyzing a company, understanding their financials, assessing the management, and even figuring out what they're worth.
And remember, the goal isn't to find the one right answer.
Right.
It's about getting a range of possible values
Okay.
and then using that information to make an informed decision.
So to wrap things up,
Yeah.
let's leave our listeners with a final thought.
Okay.
We've seen how, credit rating agencies can be this surprising source of industry insights. But as we've learned in this deep dive, knowledge can come from a lot of unexpected places.
Absolutely. So our challenge to you is to keep exploring,
Yeah.
keep asking questions, keep digging for those hidden gems of information that can give you an edge.
Talk to people in the industry.
Yes.
Read industry publications.
Attend conferences.
You never know where that next aha moment will come from.
Exactly.
And most importantly, never stop learning.
That's the key.
That's what makes investing so fascinating.
It really is.
Thanks for joining us on this deep dive.
It's been a pleasure.
We hope you've gained some valuable tools and insights to help you analyze companies
Yes.
with confidence. Until next time, happy investing.